following the big bailout of Spanish banks over the weekend. But our next guest says not to give in to geopolitical paranoia. Frank Fantozzi, Planned Financial Services CEO, joins me now. Why do you say that? I mean, I'm sorry, but I think we were looking for a little more of a pop on the markets today than we're getting right now, Frank. What's going on?
Well, I think, Cheryl, everyone was figuring the same thing, but I think overall the market already had that baked in, and I think they're still looking ahead to see what's going to happen in Greece in about a week or so. So, you know, when you have a lot of chiefs trying to run around and control what's happening in Europe, you know, we struggle with our own kind of TARP bailout. And we had one country and a divided Congress. You can imagine it's a little more difficult in Europe when everyone kind of has their own agendas at times.
But you pulled back your equity positions in the month of March. I mean, you actually acted a little bit earlier than many of the major market participants did. Why? What were you seeing that sparked your sell-off?
Well, there's a few things. I mean, this is a three-peat. I mean, when you look at the previous 2 years, we had a correction going into summer. We've had slow growth, so we've had 2.25% is our anticipated GDP growth, and we were getting mixed signals. And when you get mixed signals and there's uncertainty in the marketplace, people tend to go negative. And I think we felt that, given the indicators that we saw, that, you know, over the summer, I think we were going to see a slight pullback in the marketplace. But we're still optimistic that equities for the year are going to probably fall in the 8 to 12% range by the end of the year.
You think that we're going to fall 8 to 12% by the end of the year?
No, they're going to fall in the range. I'm sorry, fall in the range. They're going to post an 8 to 12% gain for the year.
Okay, I want to make sure that you weren't telling me that I was looking at a market sell-off. That would not be good. All right. Well, you know, in particular, though, Frank, if you look at the S&P 500, I mean, we've already had that quote-unquote correction, if you will, that 10% drop for the S&P 500. Wouldn't you, or could you argue that really this is the time to maybe make some good investments, take some of the down opportunity, and then kind of our viewers could be bracing themselves for what could be that jump back up in the fall that you're predicting?
Yes, it's actually, you know, people should look at it as an opportunity, but when you get into investor behavior, I think that's always the trick. Everyone's feeling that they want to see some more positive signs, they want to see the market start to grow, and then they try to hop on the bandwagon. But by that time, you know, a lot of the gain is already kind of baked into the return already. So we do encourage people to start looking at, you know, participating back into the marketplace. There's a few sectors that we feel are going to play very strongly for them.
What do you like?
We've been well, we definitely like industrials. We see that the emerging markets are going to create demand. Even with China slowing down, I think that's going to turn around. Technology, companies are looking to be very, very efficient, so they're spending a lot of money on technology overall. So I think that's going to post very well.
But Frank, tech is up over 8% over the last 6 months. You're not concerned that the tech run is already over?
No, I think that's going to continue for the year. I think it's a strong sign that companies are looking to reinvest, be more efficient, be more effective in how they're deploying their assets and resources.
Yeah, you like industrials as well. I know you mentioned technology. You like industrials. Here's the thing. I also was looking at your portfolio strategy. You're picking high-quality mortgage-backed securities. What does that mean?
Well, you know, as part of the defensive measure, we're obviously not in favor of treasuries. I think treasuries are overpriced and quite dangerous at this time. And, you know, we're looking for economically sensitive type equities, so mortgage-backed securities, your high corporate yield bonds. I think those are all going to lend itself that when the market starts to, you know, improve, those corporate type securities, fixed income, will do well for investors.
Frank Fantozzi, good to have you on the show, Frank. Thank you for the picks.
Thank you, Cheryl, for having me on your show today.
All right, new warnings about California, which has a budget deficit of almost $16 billion and the lowest credit rating of all 50 states.